Did you know that in 1999, the Bank of Japan dropped interest rates to zero? This was the first time any central bank had ever done this. This means that this was the first time that if you wanted to take a loan, you wouldn't have to pay any interest. But why did they do this? To understand, let's take a look at what went down in Japan between 1960 and 2001. Between 1960 and 1980, Japan had transformed itself from a largely agricultural nation to the world's second largest economy. They were making cheap products which were being sold all over the world. Their economy was growing at 3.89%, more than even the United States' 3.07%. Their stock average hit an all-time high on the 29th of December in 1989. And importantly, real estate grew extremely valuable. Commercial land prices increased over 300% between 1985 and 1991. But as asset prices increased, so did speculation, especially in real estate. So people kept pumping money in. And then in the 1990s, this economy, which the whole world envied, ran into trouble. The Bank of Japan was worried about inflationary pressure and about the asset bubble that had formed in the housing and the stock markets. So they began a series of steep interest rate hikes, from 2.5% to 4.25% to a whopping 6% between 1989 and 1990. And this asset bubble, it just popped. The stock market nosedived 43% in a year from its all-time high, and land values fell a whopping 70% through the 90s. Rising rates made borrowing expensive, and speculators defaulted on their investments. So, between 1991 and 2001, the Japanese economy entered a period of deep recession, a time so bad that it's called the lost decade. And that is when the central bank slashed interest rates to zero to address the stagnation and deflation. They were hoping that people will borrow and they will invest and they will spend. But people didn't do that. They were sitting on the money. This can happen for a bunch of reasons, like people weren't confident that investing will give them enough returns, or that they thought that goods and services will become even cheaper, so they were waiting to spend or consume their money. This is when the chief economist at Japan's biggest brokerage coined the term balance sheet recession. This is when people don't borrow money since they are concerned about asset prices. They only are interested in reducing their debt. Now, this is also called Japanification, drawing from this story. So basically, this particular move to cut interest rates to zero failed at that time to revive Japan's economy, although other measures later did help them start to get relatively back on their feet. But the reason that we discuss this whole case is that 3 decades later, a somewhat similar story appears to be playing out in another country, China. This came more into the limelight when economists at JP Morgan pointed out some eerie similarities between China's situation in 2021 and Japan's in 1991. Both the world's second largest economies, both export powerhouses known for consumer electronics, both with a housing crisis, both with an aging population, both with a similar debt burden. But are these similarities enough to predict doom for China, or is there a way out? Let's first look at how the similarities are playing out. First and more important, the housing market. For decades, a strong real estate market propelled China's economy forward. In 2020, property accounted for a reported 59% of household wealth in China, according to a People's Bank of China survey. The huge real estate expansion saw developers building multiple facilities over the last few years. And as people speculated on housing prices, real estate prices tallied up to 50 times the national income. Then the government stepped in, developers began to default. In fact, one big developer in China already defaulted in 2021 and another one may soon enough. Now house prices have dropped and people who invested their money in real estate have also suffered. Sounds familiar? Also, now while the rest of the world is increasing interest rates to battle inflation, China is doing the opposite. They are cutting rates to try and boost the economy. Again, sounds familiar? According to JP Morgan economists, even the pace of increase and the level of debt problem in China today is comparable to Japan in the 90s. The next important thing is the aging population. In 1991, 12.7% of Japan's population was above the age of 65. This is similar to China in 2019, where 12.6% of the population is above the age of 65. So does this mean that China is going to tread down exactly the same path as Japan? Of course not, that can't happen. First of all, no two situations are exactly alike. Plus, both these countries are also very different, as are their situations, the time right now and their policies. In terms of just data too, there are some important differences that the economists at JP Morgan have pointed out. One, China's urbanization ratio in 2022 was 65%. Japan's in 1998 was over 77%. This means that China still has larger potential for productivity to increase because their labor can migrate from agricultural to non-agricultural sectors. This also means that there is potential for housing demand to increase. Second, China's domestic market is much larger. They have a large number of science and engineering graduates, and their manufacturing sector is very comprehensive. Third, economists believe that China's housing price overvaluation is also not as severe as Japan's was in the 90s. But while these factors are in China's favor, there are a couple of metrics that can play spoilsport. One, China is aging a lot more faster than Japan was, as is visible in this graph. So they could actually grow old before they grow rich in this demographic trap. Secondly, China is facing a more challenging external environment. According to The Economist, the China versus US competition today is more complex than the Japan versus US was in the 90s. Third, China has comparatively limited room for macro policy stimulus because their public debt right now is higher than what Japan had back in the 90s, so their bank is also comparatively more constricted. Fourth, the Bank of Japan's policy rate was 8.1% in Jan 1991. And then they kept cutting interest rates till it reached zero in 1999. In China, the policy rate is already low at 1.9%. So there's less room for them to cut more. So while Japan's past will not exactly be how China's future plays out, considering that the time is different and the factors that led to the slowdown are different, China of course had to also grapple with the after effects of the COVID lockdown as well. But an unprecedented slowdown definitely is happening in China, and this is sending their economy churning. Hope you enjoyed this video. For more such content, keep watching Money Control.